Good afternoon and welcome, everyone. And thank you for joining us today. My name is Renee. I'm one of the directors here at Apex Private Wealth, and we're thrilled to have you here for our webinar with Duncan Artus, where we will be navigating South Africa's post-election economic landscape and the investment markets. A bit of housekeeping. For any reason the link stops working or there's an interruption in connectivity, please just leave the webinar and reconnect. The agenda for this afternoon will be a business update from Brandon, followed then by Drew welcoming Duncan and a brief intro into what we can expect this afternoon. We then have the man of the hour, Duncan, taking us through a couple of his slides that he's prepared around this particular investment topic. And then throughout the webinar, please feel free to share your questions, comments in the chat below in the Q&A session. And we're here to make sure that you have valuable takeaways. So at the end of the webinar, we'll be addressing those questions. And so please feel free to leave any questions that you may have. So with that, let's hand over to Brandon. Thank you.
Hi everyone, and thanks for joining us this afternoon. I would like to provide you with a short update regarding our business and all the positive news surrounding it. In the last few months, we've had a new advisor joining us, Carolyn. Carolyn has chosen to partner with Apex Private Wealth to ensure continuity for her clients. We are excited about her coming on board as she expands the range of knowledge within our existing team of advisors. We look forward to our journey together and meeting all of your clients. We are also very excited about moving to new offices in Rosebank. We have unfortunately outgrown the existing office space which we have occupied for the last 10 years, and therefore we are moving to a larger space which we can grow into. This move will take effect from tomorrow. We look forward to welcoming you to our new offices in the future. Lastly, I would like to take this opportunity to congratulate Renee as being nominated as one of the 3 finalists in the FBI Financial Planner of the Year competition. We are very proud of you and the value and the expertise you brings to the table for Apex Private Wealth. I now hand over to Drew to introduce our speaker, Duncan Artus.
Good afternoon. For all of you who know me, you know I'm perpetually optimistic about South Africa, and maybe perpetually hopeful is a better word. And so the outcome of the elections earlier in the year were the best case I could have hoped for, because hopefully this is the start of us turning around, the start of getting some real growth in our economy. We've seen the currency improve, we've seen our bonds do really well, and South African shares do really well. So I'm not going to spoil the presentation, and I'm going to allow Duncan to tell you kind of where we are and what we can expect over the coming years. Duncan is the Chief Investment Officer at Allan Gray. He's been at Allan Gray since 2001 and was made the Chief Investment Officer in 2020. And he does manage a part of the Allan Gray Equity, Balanced and Stable funds, funds that we use a lot in all of your portfolios, and we include and think do a very good job. So I'm now going to hand over to him to do the presentation. Thanks.
Thanks very much, Drew, and good afternoon, everyone. I'm just going to share my screen quickly. There it is. Cool. Okay, there it is. Yeah, so good afternoon, everyone. Thanks very much to Drew for the nice introduction and to Apex for allowing us to present today. I'm just going to go back over there. Yeah, so as we mentioned, we're going to be going sort of through a bit of our thoughts on the investment world post the election. And I do just want to stress, I'm not a political analyst, but obviously at Allan Gray, we do get to meet some interesting people, and people like to hear sort of our view on certain things. So I think the one thing to put it into perspective is it's not only South Africa that had an election. There were many important elections taking place around the world. And you can see that the countries shaded in red there were actually holding elections this year, which is pretty amazing if you consider the biggest gray area is China, where you actually don't have an election. So a Deutsche Bank study, and I feel sorry for the person who had to go and do it, from 1800 to today, this is the highest percentage of the world population that has voted in 1 year. Now, normally we wouldn't really pay too much attention to politics, whether it's Republican or Democrat or Tory or Labour, hasn't made that much difference over history. But we do think this year is important because a lot of the elections, the people had quite different policies which can affect your investments. Now, obviously, the one we're talking about is the South African election. This is just a chart we made before the South African elections took place. So I think it's important for everyone to understand it wasn't obvious what was going to happen. And we were very surprised in the year leading up to the election. We got very few questions from clients sort of about the politics in South Africa and about the elections. But the closer we got, the more sort of questions we were getting. Now, obviously, you don't know what's going to happen. And I always find it interesting, sort of 6 months before the election, no one had even heard of the MK party, right? And they're actually the people who ended up taking out the ANC if it wasn't the DA. So what we showed was when we're looking at a portfolio, we didn't want to bet on either outcome in the election or either a very good result or a very bad result. What you kind of want is a portfolio that, one, can protect you in terms of a bad result, and two, have assets that can perform in any of the scenarios. So this is just a simple probability curve. I mean, you can see where it's labeled left tail, that's a very bad outcome. And sort of there's deterioration, and then sort of the status quo, kind of where we were before the election, I'd say closer to deteriorating over there. And then you have sort of the right-hand side of the distribution, the red there, where things improve a little bit, markets start to price an improvement, and then you have the right tail, which is obviously a very good reaction by investment markets, kind of maybe along the lines we saw in 2002 to 2007 in South African markets. Now, when we looked at the portfolio, we put more emphasis on protecting it against the left tail scenario, but also owning assets in the right scenario, which would benefit, as we've seen over the last while, as markets have priced in an improvement. So our actual performance on an absolute basis has been strong, but we would have underperformed some of the people who would have positioned their portfolios to only benefit from a good scenario. But we don't think that's the correct way to manage a portfolio. So what do I mean by a right tail scenario? This is just a slide my colleague Talia, who's the head of fixed income, made, and we just wanted to demonstrate to people how important real growth is. As we all know, for a number of years, South Africa, I think the medium-term budget is out today, and the people are celebrating 1.5% real growth target. We need to grow way faster than 1.5% given our unemployment rate. Now, just to show you the difference, what we did here is the black line is South Africa's GDP 4 years after apartheid. So giving the ANC some credit, that it would take a while to put their policies and people in place. And you can see the black line, it goes along, and that's how big sort of our economy would be at around sort of 7 odd trillion rand today. If we'd grown at 5% real, and you add an assumption of inflation, I think we used 5%, you see the economy would be almost 11 trillion rand. So it would be 3.8 trillion rand bigger. And that, I think, would solve a lot of problems in South Africa. You wouldn't have to think about redistribution. You'd have way more revenue from tax receipts. Unemployment would be much lower. Company profits would be much higher, etc. So we just wanted to put it into context, because sometimes people, the difference between 1% and 3% doesn't seem that big. But as you know from your investments, if you compound it over a long period of time, it could be good. Drew mentioned that, we've had a rally in South African asset prices. And in particular, what we've been talking about at Allan Gray is this sort of repricing of South African credit risk over the last decade and a bit. And what I mean by that, you can see how it's a line here going back to 2009. And this is the interest rate the South African government pays on a 20-year bond. And lending to the South African government for 20 years is obviously quite a long period of time. So this is a very good barometer of how the world views South African riskiness. And you can see from 2013 up until the beginning of this year, South African credit has basically been repriced upwards. So the bond market, the fixed income market, global investors have basically been sending a signal saying, other than a few spikes like Nenegate or the pandemic, or occasional sort of periods where people are quite bullish like 2018, people have been demanding a higher and higher interest rate to lend to the South African government for long periods. And what you can see on the far right there, which we've labeled sort of JFECRA, which is a technical term for gold and foreign exchange reserves, and obviously the GNU is the Government of National Unity. I'm happy to take questions on Jafekro afterwards, right? It will take me about 10 minutes to explain it, but effectively we used some of our gold and foreign exchange reserves, we revalued them, the Reserve Bank gave that money to the Treasury, and so next year the South African government has to issue 100 billion rand less bonds because of that transfer. And then obviously people have become more bullish just because of the Government of National Unity, and that we avoided the left tail scenario, which would have been an ANC, MK, EFF sort of alliance to run the country, and maybe even the ANC splitting in two. Now that rally is significant that we can see in the interest rates. And we got as low as 10.7%, I think, on the 20-year. We've kicked back up to, I actually went and wrote down the number, to about 11.2. So there's been a bit of a sell-off over the last couple of weeks. But why is this important? Obviously, the government pays less on its interest. It means it can spend revenue on things that are more important. And second of all, it lowers the cost of capital in South Africa. So this was a very, very high cost of capital. If you could get sort of 12, 13% lending to the government risk-free, sort of any project or any share or any valuation would be quite depressed, and you have a very, very high hurdle rate. So this is very, very important. And not only have our bonds been very strong in rands, and not only have our shares been very strong in rands, but the rand has appreciated too. So in dollars, the returns for South African bonds, I think, have been somewhere between 30 and 40% on the long end. And many South African shares are up 30, even more, 100% in dollars over the last couple of months. So it really has been a big move. And this just puts it in perspective. You know, you can just see various different currencies around the world versus the dollar. I mean, the main other currency that's been strong is the pound. I'm sure as anyone who's traveled to England recently would know. The other interesting thing about this slide is there's something else we've benefited from, and that is global markets have turned a bit on the two emerging market darlings of the last 2-3 years, which have been Mexico and Brazil. So Mexico and Brazil have been attracting a lot of the flows, and due to political developments in Mexico, so they elected, again, a fairly socialist prime minister, and they've introduced some, I guess you could call, interesting political policies. And the same thing happening in Brazil, obviously with their sort of reasonably socialist sort of spending policies they brought in. Money has also said, well, those were good stories that are getting worse, and South Africa was a worse story that's getting better, and we have benefited from those flows. I do just want to say something. So the bonds have rallied and the currency strengthened, but if we compare the fundamentals of South Africa before COVID to today, you can see we're going to have to do some heavy work and perhaps keep improving the fundamentals because the fundamentals have not improved yet in line with that decline in interest rates. So on the left, you can see there's the 20-year bond before COVID, so roughly 10%. As I said, we're sitting just around 11% today. If we look at the next column, which I think the finance minister was focusing on today, what was debt as a percentage of our economy, as a percentage of GDP? And you can see we were mid-50s, and today that number is over 70% and probably heading closer to 75. And most sort of foreign investors have been concerned, not about the level of debt. I mean, obviously developed countries are much higher. They're more focused on the speed at which we've gone from low levels to high levels. The one thing we look at when we evaluate countries, especially for our Africa Fund, is of your tax revenue, how much goes towards paying interest? Because obviously what you're paying on interest, you can't spend on education, you can't spend on infrastructure. And you can see before COVID, roughly for every 100 Rand of tax revenue we got in, we were spending 15 Rand on interest costs. And that number, if you include the guarantee the government did for Eskom, is roughly sitting at around a quarter now. So that's number we need to bring down, both through economic growth and hopefully lower interest rates. There's another sort of strange thing that I didn't actually focus on a lot until a year ago, which my colleagues have, which is, so how much cash does the South African government actually have in its bank account that it can run the country with every day? And you can see before COVID, that number was sitting at around 300 billion Rand. Believe it or not, a couple of months ago, before this Jafekra sort of transfer from the Reserve Bank to the government, we only had 40 billion rand in the South African bank account as we sought to run a 6-7 trillion rand economy. So that was not a great place to be. So what makes this time a little different before the election was this is the percentage of South African bonds that are owned by foreigners. And the red line shows how much was owned by foreigners. You can see sort of in 2018, it peaked at just over 40%. But obviously what's happened over time is, South Africa entered the World Government Bond Index. So that means all sort of passive investors and investors who have a benchmark that says you can only invest in bonds that are in the Global Bond Index. We attracted lots and lots of flows, you can see from 2011 to 2018. But with the deterioration in South Africa during the Zuma years, and I guess sort of load shedding and what happened to the economy, we were brought down from investment grade to junk grade, and you would see there the label South Africa exits the World Government Bond Index, and now foreign ownership is as low as 25%. That's ticked up since the election, but what we really need, given the amount of money South Africa has to borrow, we need foreigners to come in and take up again somewhere between 30 and 40% of the bonds that the government issues, which again will help keep interest rates lower. So this is something we're watching quite closely because the foreigners have come into the bond market before they have into the all share index, into local shares. Just one thing which I guess the guys would have been taking through with you quite often. It's been a tough time to generate high absolute returns in South African shares. And so what we've seen in the unit trust industry in South Africa, in savings industry, is lots of money has flowed into money market funds, into income funds, and into bond funds. And the reason that's been is people have said, well, you keep telling us equities are a better place to be over the long term, but if I look back over the last 11 or 12 years, shares have hardly outperformed bonds, and over some periods have underperformed, and fixed income is a lot less risky. So one way to show that is here going back sort of to 2014. The red bar is just saying, if I invested the money in the stock market and I'm minus investing my money in a money market fund, what would it look like? So when the red bar is above zero, it was better to be in shares. When the red bar was below zero, it was better to be in cash. The dotted blue line is the 124-year average. And you can see South Africa has actually been a good place to invest in shares over the long term. They've delivered sort of 6 or 7% more than cash. The dotted black line is the last 10 years. And you can see that number has been roughly 3 to 4%. The other thing you notice is not a lot of high red bars. The only high one was really 2021. And that was really just regaining the losses you'd made during COVID. Excuse me. The one last thing, the one just to add, so how does the year at the moment look like? That number is running at around 10%. So shares have done 10% better than leaving your money in a money market fund over the last while. So we know, if I look at sort of the average valuation of shares, are we going to see a period like 2002 to 2007 again? I think it's probably a bit unlikely that we get sort of 5, 6, 7 years in a row where the equity risk premium is called closer to 10%. But forecasting the future is pretty difficult, and I'll just try to take you through some of the things we look at. So this is just the all share index, and it's saying how much are you paying for each rand of earnings of the South African stock market, and you can see that line obviously fluctuates over time. Sorry, Renee? Is there a question? No. There's the red line fluctuates over time, and the PE ratio is certainly not high at the moment. So valuations, we would say, are reasonable on the South African stock market. But I just wanted to highlight to people just how much good news people have priced in the short term. So as the election happened, the stock market is obviously forward-looking, and people have priced in a lot of good news. And as an example, I just used Mr. Price. So the foreigners typically buy shares like Clicks, Mr. Price, Capitec, Foschini, and this is the share price of Mr. Price in grey base to 100 in 2021. And you can see it was off by almost 40%. And now you've had this huge rally in the last 2-3 months where the share price has increased significantly. To put it in perspective, Mr. Price is now trading on 20 times its last profits. And that number was closer to 11 or 12 before the election. So it just is important to know that people have priced in a lot of good news. And on the companies we've met so far, other than saying there's more confidence and people are feeling better, nothing has really improved that much on the ground yet. People are also excited about the retailers because of the two-pot system. Hopefully, none of you guys accessed your money. It's better to leave it, as you know, in savings, but obviously a lot of South Africans have invested that money. Just one thing, when we're looking at South African shares, to remember that if we look at the all-share index, many of the big shares are actually international companies. So this just shows the breakup of the all-share. The sort of red is Naspers as the biggest share. Then we have a whole collection of multinationals, sort of AB InBev, Richemont, Nepi, Aspen, which even though they're listed in South Africa, are actually not South African companies. The yellow is obviously the mining companies, Anglo American, BHP, Bulletin, and the green is really the companies that make most of their money selling their services or goods in the South African economy, such as the banks, the retailers, and the food producers. So I just wanted to give you hopefully an interesting example of how sort of depressed South African asset prices have become in dollars. On the left, Alan Gray's clients are top 3 shareholders in most of the hotel and leisure companies in South Africa. So if we took City Lodge, plus Southern Sun, plus Sopo Sun, plus Sun International, in June, you could buy 100% of all 4 of those companies for only $1.7 billion. If we look on the right, the Chinese Sovereign Wealth Fund paid $2 billion just for the Waldorf Astoria. And having walked in the Waldorf Astoria once in my life, I can tell you it's quite an old hotel in New York. And just to put it in perspective, just Southern Sun has 17,000 hotel rooms in South Africa. Just to show the extent of the rally, that 1.7 billion is now $2.3 billion this morning. So if we just think about that green segment and what's in South Africa, these are the type of companies we have in the portfolio outside those big multinationals. So you can see some of the banks on the left-hand side, something like PSG Financial Services. As I mentioned, sort of the 4 sort of hotel, leisure, and gambling companies. We have some of the retailers, our biggest position being Woolworths. We actually own all 3 of the food producers. And then, we own sort of various other sort of industrial companies. And what we've tried to do is also say which companies will not only benefit from a South African economy growing stronger, but also have some kind of self-help story. So I'm not going to go through all 4 of them, but Woolworths, even though the food business continues to do very well, obviously the fashion, beauty, and home is still earning much less than we believe it should in terms of margins. So we think that can improve without the economy improving. Standard Bank is coming from a little bit off the back foot in South Africa in retail banking, but where they're very interesting is their huge African operations, which they've spent many years building up and making around 40% of their profit. Remgro, you would recall, sold their liquor business, Distell, to Heineken, and in return, they took 25% of Heineken Africa, and we're still not 100% sure what happened, but Heineken actually lost money in South Africa last year. So we think that can improve, and Remgro management are doing lots of good things to their portfolio. And then another company like Tiger Brands, which has really, really struggled from being the premier food company to battling over the last 5 or 6 years. So just to finish off with in the last couple of minutes, and then I'm happy to take questions. Most of our clients are invested in the Balance Fund. It's the biggest unit trust in South Africa, just under 200 billion rand. And this just shows you sort of where Alan Gray's best view is within Regulation 28 of where we would allocate our client savings today. So you'd see roughly around 65% in shares and the rest sort of in fixed income and commodities. And we're roughly sitting sort of around 63% in South Africa and 37% sort of offshore. But the important thing, as we highlighted earlier, some of those local shares will obviously be offshore shares listed in South Africa. And so if we look at our portfolio and we take AB InBev and we take Glencore and we take Mondi, we think the true offshore number is closer to 60. Those are the top 10 shares of the balance fund as of the 30th of September. You can see that on the fact sheet. So you'll see a mixture of those multinational companies, which hopefully would have protected the portfolio in that bad left tail scenario if the elections hadn't worked out the way they had. And then a number of companies focused on the South African economy, that can benefit if we do get higher growth and better policy. So just to finish off with, I guess we can say it's fairly easy to look back now and say, okay, well, the election outcome was definitely going to happen. I'd just like to point out again that almost the entire support the ANC lost went to the MK party, not to the DA and some of the other smaller parties. And certainly in our discussions with some of the policymakers, the government of national unity probably still has to have its first big test about whether it can stay together. And we saw that with, Cyril sort of calling Mr. Putin our ally. And so we've tried to have a portfolio that can do well in a lot of outcomes, offshore holdings, sort of precious metals, some equity hedge in the portfolio, foreign businesses listed in South Africa, and then sort of businesses that can benefit from both our bonds being strong and the economy growing faster. So I'll end it over there, guys, and I'm happy to take any questions, Renee or Drew.
Perfect. Thanks, Duncan. I think that was exceptionally valuable. I think a couple of questions have come up. You mentioned Mexico, you mentioned Brazil. If we compare South Africa now to the other basket of emerging markets, and we've seen sort of the BRICS expanding in scope as well, how do we look in terms of the investment potential? And you've kind of briefly touched on it, but how much of that is linked then to the GNU? How much of that is linked to doing the right couple of things over the next couple of years and this GNU actually working? And then from there, the second part of the question is, we've recently been upgraded by the IMF in terms of our growth projections. What kind of growth do you think we could see looking back at, what we've seen in terms of the lost growth?
Okay, thanks, Rene. So just to put it in perspective, South Africa is around 3.5% of the emerging market index, of which NASPAS is a big portion. So, the foreign investors tend to focus on the bond market and some of the bigger shares. Where we have benefited from, let me just put it back. Emerging markets have still been a very poor place to be. If you take the performance of emerging markets relative to the world index, it's almost at an all-time low. So almost all the equity returns globally have come from the US stock market, plus a couple of European things. So we haven't benefited yet in South Africa from money moving from America to emerging markets. So that can still be a positive. Second of all, the other big thing that's changed is China made almost 30 to 40% of the emerging market index at the peak. And I think for most people who watch the markets know, China's been a very poor place to invest up until 2 months ago for a very long period of time. And with the rising geopolitical tensions, there are quite a lot of pension funds in Australia, America, and Europe where they've said, we want to invest in emerging markets, but exclude China. We don't feel it's proper to invest in Chinese companies, that could be helping the Chinese government in doing whatever they do. So we have benefited from all of that. And then, who do people compare us to? They mainly compare us to Brazil. So Brazil, they're kind of the same as us, sort of had sort of leftist leaning sort of government, quite expansive sort of fiscal policies, and very commodity based like us. As you would know, Brazil, earns most of its foreign exchange from exporting minerals just like us. So people compare us to Brazil quite a bit. And so we benefit, I think, when people think Brazil's not doing as well as us. The one thing we don't have that Brazil and Mexico and China and India have is obviously a massive population. People forgive you for a lot more things if they know one day they can sell to 150 or 200 million people. It just happens that sort of way. And that's why sort of the other darling has been India. So I think, compared to Brazil and Mexico, we don't have the same growth prospects at the moment. But I think people have priced our fixed income relatively close to Brazil. Mexico obviously has the offshoring story. So Mexico, I was actually there last year with AB InBev. I mean, Mexico City looks much better than Johannesburg. I can tell you that. I was expecting it to look a lot dirtier and sort of run down. And they're obviously benefiting from lots of companies moving their manufacturing to be close to the United States because of the sort of onshoring. And then what kind of growth? And I don't know yet, but I know we need to grow much faster than 1.5 real. When we look at other countries in Africa, obviously coming from a much lower base, they're growing at 5-6%, which with much less sophisticated financial markets and sort of much less infrastructure. And I think the sort of bottleneck is still in our sort of things when we speak to businesses. Two things. One is infrastructure. And I'm sure any of you who've driven on the roads in Mpumalanga, obviously all the trucks going because we haven't been able to send it by rail. I mean, I've got the actual Cape Town harbour behind me here. AVI, who own INJ, will complain all the time about how the harbour is working. So there are lots of things we need to get working. And then I think the thing that's most difficult, and we're watching, and I guess it's been quite disappointing speaking to the businesses, because there's this a lot of positivity about the GNU, but actually the people who do stuff are the municipalities. And, we need to get the municipalities working. So, there's electricity there, the roads are working, the water's working, etc. And I think that's where, the government of national unity still needs to sort itself out. It's at the lower levels, below the sort of cabinet and sort of higher levels. So you're on mute, Rene.
Yeah, sorry. With rising global economic pressures, how is South Africa positioning itself to remain competitive in the international market?
So I think there's two things. So one is South Africa is a commodity country. So we do well when commodity prices are high. So if you believe global GDP growth is going to be very strong, and you're not as bearish as we are in China, and China can come through this sort of very low economic growth. South Africa is a very open economy. Other than cars, we don't manufacture and export much of volume other than commodities. So we need commodities to be strong. And I think there definitely is a sort of a bit of a tail risk to South Africa, which is exactly what we saw last week, which is the world is very clearly splitting. And we've been talking about this for 3 or 4 years. And we had to focus on that because of China. Because NASPAS is such a big bit of most people's savings in South Africa outside their house, we were quite focused on the sort of West versus East, if you want a simplistic way of saying it. So we've seen deglobalization, as I said, onshoring. And I think South Africa's caught in the middle there. And that's going to be an interesting thing for the GNU to do, because we make most of our exports from the West. And Standard Bank run their systems using American IT systems. And, their counterparties are JP Morgan and Morgan Stanley. So we don't want to end up kind of being, I guess, put in the sort of Russia, China, if there is any breakout or increase in geopolitical tensions where, we could end up, in the worst case, being sort of sanctioned, as we almost became a year ago, with the Russian sort of arms that were sort of sent from Cape Town. So I think it's going to be a tricky environment to navigate, but I think that's true for almost all emerging markets around the world.
Sure. And I guess with the US election, is there potential for that AGOA agreement to come under scrutiny again, depending on who comes in from that perspective as well?
Yeah, I mean, it's a tricky thing because, as I say, I think it's a bipartisan thing. So it's one of the few bipartisan things in America. The Democrats and the Republicans both agree on keeping in China, right? I mean, that's just a natural type thing, yes. But if we are seen associated as helping Russia or aiding Russia, I think, the AGOA Act could come under pressure again. It just shows, South Africa is not a massive piece of the world. So we just got to be careful how we sort of conduct ourselves. But it's going to be tricky if the world keeps splitting like this, which we've seen across all different kinds of countries at the moment.
Yeah. The last question that we have here, Duncan, is what we saw from the medium-term budget policy statement is that the budget deficit is expected to widen to about 5%, which could lead to more government borrowing and affect bond investors. What steps do you think the government should take to reassure bond investors and stabilize the bond market?
Yeah, so I think that, so we're running a 5 or 6% fiscal deficit. And that's obviously there are 2 line items there. There's revenue and there's costs. The one thing we would say, and we do have a slide we can send one time is the Treasury's estimate of where debt to GDP is going to be has always way underestimated where it ends up. So every year in the budget, it shows debt to GDP coming down over the next 5 years, but it's kept going up. And that's kind of what people were worried about in the bond market. So the one thing is that we haven't had a chance to look at the budget yet. The guys are upstairs taking a look at it. Is one is obviously we can grow faster, right? So then you have more revenue, more tax revenue, more GDP growth. And that's, as I mentioned, lots of structural issues like logistics, like the ports, like Eskom, just to give businessmen confident to invest, because businesses have held back investing because the cost of capital has been so high and because we've had low growth. I guess the other way you can try to bring that debt down a little bit is expense control. And that'll be interesting to see, because obviously a very large portion of the ANC support base is unions. And we'll have to see. I mean, the finance ministry, to their credit, have been quite good on that wage bill over the last couple of years. But it does compound against you if it's growing at 1 or 2% real for a number of years. So it's just sort of improving the structural things to improve revenue, and then trying to keep hold of the costs while still investing. And, for not because I live in the Western Cape, but, if you look at the difference between the budget of the city of Cape Town and the city of Johannesburg, a lot of the city of Cape Town's budget goes into investment, not OPEX. Whereas in Cape Town, in Johannesburg, it's the other way around. And that's why, Cape Town's infrastructure looks a lot better than Johannesburg's at the moment, because they've actually been spending on pipes, on roads, and on various sort of other things like that.
Yeah, brilliant. So Duncan, that's it from the questions that we've received. I think, great rundown, gives us a lot of insight into what's been going on in terms of the market and how to navigate it. And I think things are looking up across the board. So I think to wrap up, what we'd like to do is thank yourself and Alan Gray for the insights that you provided to us and our clients this afternoon. And then lastly, to our clients, we are exceptionally grateful for the support that you provide us throughout the year. We're in the final quarter of 2024, if you can believe it. And if there's any question that you have after this webinar, please reach out to us. We have a team available to you at any time as well. And again, thank you for your continued support and for attending this afternoon. We wish you well, and thanks again. Thanks, Duncan.
Cool. Thanks, everyone. Goodbye.